Evening everyone. Triple reason tonight to be slightly nervous. Going on after one of our expert fund managers, who we invest in, Henderson's strategic bond and their monthly fixed interest bond form core parts of the portfolios that we run. Just give you an idea of, you don't have to understand everything that Rebecca did, I do. And it's about lending companies, sensible companies, money they're going to make us a longer term return. Second reason to be nervous, we've invited the cream of our clients here tonight. It's always nervous speaking in front of you guys. Thirdly, we're being videoed as well. Henry assures me he wants to do it in one take, so if we make one mistake, we've got to go all the way back to the beginning again. So, briefly going to talk about what happened since the last investment seminar, then the process of how we select funds for the portfolios, proof of pudding, some of the funds we've chosen in the past, have they done well, have they not done so well, the rewards, some real life examples of clients that we've invested for, then some performance, and with performance there's always risk is the secondary matter in that, and there's some questions and answers afterwards. That's our world since November. It's been extremely quiet. Anyone know those two people? Must have been. Donald Trump and Janet Yellen. You can be really honest with me now. Does anyone read the quarterly reviews? Does anyone read January's? Because in January I said quite boldly that Donald Trump would get nowhere near the White House. So you can see I don't wear scratch cards or lottery tickets. My predictive powers aren't very good. Although I have drawn Belgium in the Euros, so still hoping up for that. The lady is Janet Yellen, probably the most important lady in the world at the moment. She's the head of the Federal Reserve. And it was her decision to raise interest rates in December, which we felt was a good thing. Where we felt she probably got it slightly wrong, and there's all different layers of wrong, I should know, I've been married for 15 years, is she said there were going to be 4 interest rate rises this year. That spooked the markets. That's why we saw a rather large dip when we woke up with a hangover on January the 1st. She came out on February the 11th to say, actually, going to manage expectations here, we don't think it'll be 4, it might be 1 or 2. And remarkably, the markets thought that was great and came back up. What else happened? Syria started raising its head again. My North Korean doppelganger, the similarities between me and Kim Il-un is scary. Donald Trump started to look a bit more smug, and Hillary started to look a bit more concerned that Donald might be getting a bit of traction. And the Brexit was announced for last week. I could have got a better picture of Boris, but all I think crazy pictures of Boris, it's a bit more entertaining. But finally, we did have Brexit and the outcome, but also the year so far has been permeated with terrorism as well. It's quite easy to forget, and the market's become a lot more sanguine about these attacks. The latest one being obviously in Turkey, where 41 people unfortunately lost their lives. It's becoming more and more prevalent. So that was the year so far. And the biggest thing was that was the drop on Friday morning of the FTSE 100 that has subsequently gone up again. So that's the background. All that background, how do we on earth decide on what funds we're going to select for our portfolios and ultimately your investments? We have a thorough process. We named it after who should we do today? Gerard. It's called the PRETTY process. It stands for Process, Returns, Expenses, Team Talent and Ideology. So first off, the process. How does Rebecca and John and Jenna choose their stocks, investments they're going to get into? Does the fund manager have a robust process that we can stick our money to and say, yep, that's how they're going to do it? Very important. It is the lifting of the bonnet, the kicking of the tires. Is it going to fall apart? Now they've got a proven track record, not of returns, but of sticking to what they're going to do. Returns are important, obviously, but it's not always the highest return. It's how much risk the fund manager is taking to deliver that return. And it's about different styles of return. We've heard from Rebecca that Henderson Strategic Bond only invests in mainly large cap, non-cyclical companies. That's great. But we might want to invest in another manager that invests in small cap, cyclical companies. So we get a blend of returns. Expenses is important. We want to make sure we're getting the keenest price for you guys. And expenses for us as well, making sure we spend most of our time running the money for you guys. Team and talent pretty much go hand in hand. So you've seen Rebecca, she's one of many people on the Henderson's desk running fixed interest investments. They're an extremely large team. Henderson themselves support that team with resource and budget to make sure they can do the best job they want to. They don't just sit at their desk, they have to go out and visit the companies, go on regional and global seminars. And talent, are there any specific individuals, such as Rebecca, that make sure the fund drives itself? If these individuals were to leave, is that a key indicator to sell the fund, or is the fund still going to maintain itself afterwards? And finally, ideology. Are they a large cap investor or a small cap investor? Are they looking for growth or value? Are they looking for income? And when we've got all those together, we can find out how the fund really works. And then we can blend it with another fund to get better risk-adjusted returns over the long term. That's our process we stick to. What did that mean last year for us? We did some number crunching to put some numbers to this. 728 hours of research read within our team. That's quite a bit. I'm really the dull person at the party that no one wants to speak to. 348 manager meetings. Not just face-to-face. Some of them are during conferences or over seminars. Some are over the phone. Some are a quick email conversation. And that resulted in 2015, 32 fund changes across the portfolios. So we've got the process, and this is what the process churns out, and it gives you active fund management. Proof of the pudding. We're going to go through some selection of funds we have chosen in the past. Some we already hold, some we sell. First one is BlackRock Gold & General. When we launched the portfolios in November 2004, this was one of the funds that made it into the starting lineup. We sold in November 2011. It's gone up a healthy 250%, which was really good. I remember at the quarterly seminar I explained to the advisors that we're going to sell our best performing fund we've ever held. They did question my sanity. And although it went up a little bit, we did manage to avoid that 70% drop. Why did we sell? Gold was in the portfolio as a buffer to do something different than bonds or equities. And we found going into 2011, it was becoming more correlated to the stock market. It wasn't adding anything to the portfolios. It wasn't reducing the risk. If anything else, it was increasing the risk. Property. This is Aberdeen Property Share, another one of the funds that made into the starting lineup. We sold it 2 years later. It gone up 80%. Now forgive me, I don't think a property fund going up 80% really is inherent of what I wanted out of a property fund. And again, we sold and we missed an 80% drop. At that time we came out of property completely, as well as an asset class. We continued to track it, and in November 11 we entered back into property again, but not that fund, a different fund. A fund that's predicated on providing regular income and building a slow, steady base, something that a property fund should be doing. UK equities. 2 funds, both added in February 2008. The nice light blue line is BlackRock's Absolute Return Fund. Did exactly what it was supposed to do. 2008, global financial crisis is coming in. The world is going to hell in a handbasket. People are talking about never buying a stock again. You need to stock up on tins of baked beans and hire a cave in the Brecon Beacons. We also invested in Cartesian UK Opportunities Fund. And you can see that fund pretty much tracked its peer group. It didn't add anything to it. Nothing at all. So when it came to May 2009, we sold both of these funds. One, because we felt BlackRock had done its job, big tick there. And 2, we felt Cartesian hadn't done its job, hadn't done what we expect to do, time to cut our losses and invest in something else. So we sold in May 09, we invested into Cambridge UK Opportunities, the pink line, which has outperformed the FTSE 100 over that period quite healthily. You can see the absolute return bond, still the light blue line, still doing steady, doing what it should do, but in a rising environment, that's going to hold you back. And Cartesian continued to underperform. So sometimes we get it wrong, we have to cut our losses. Sometimes we get it right, but sometimes you have to take a bit of a jump. This is Fidelity Asia Pacific Opportunities, and we invested in July 2015. Andrew Strong, who runs this fund, only launched in October 14. It's a brand new fund manager, but it has the backing of Fidelity. The resource they're giving him and the space they're giving him to make an excellent return is something we have faith in. We are the largest shareholder in this fund by a massive margin. He's gone up nearly 15% over this period since we've held him, when the average fund, when the index, has gone down 6%. He is the #1 fund over this time period. So sometimes you have to invest in the young managers and have faith. US, Loomis Sayles, solid, large cap, growth stocks. Aziz, who runs this fund, makes one change, if that, a year. It is buy and hold. And over the period we've held him, he's gone up 10%, when the American funds are in negative territory. There's periods where he'll underperform, but this guy is your rock, steady performance. It's about long term. It's all about short term as well. We did something not unprecedented, but something we don't often do. Our normal fund changes would have been on Friday, 1st of July. But we brought forward some fund changes to the 1st of June, which Stephen, who runs the operations side, was very happy about, having to do 2 lots of fund changes in the space of 6 weeks. And we moved out of our Neptune funds. We lost faith in the corporate entity, feeling that they were losing too much money and their direction away from retail was significant. So we sold out of those on the 1st of June. The first one we sold out of was Japan, which is the red line. And we bought into the blue line, which is Legg Mason Japan. Actually, they're in the same building as well. Now, Legg Mason has massively outperformed as well. One of the secondary reasons for selling this fund was that the guy who runs it, Chris Taylor, had a negative bet on the yen, thinking it would depreciate. When the Brexit came through, the yen has appreciated, hence why you've got the massive change. So by making this one change, we're 25% better off in that asset class. The other large fund we moved out of was European. Rob, who runs the Neptune European Fund, one of his main asset classes is Italian banks. Now I can understand why he's bought in Italian banks. They're extremely low value, and on a long-term basis, these should go up significantly. We sold on the 1st of June. The green line is Threadneedle, Dave Duddy. He doesn't hold any banks whatsoever. And when the result came through, Italian banks went down 50%. So again, sometimes these changes come through quicker than we anticipate. With returns and reward, we've got some real life examples. Now I've double checked, none of the clients here are mentioned, but there was a Mr. H, and he's been with us pretty much since the beginning, 11 years, and he's a high risk investor as well. He's in portfolio 10, and that has been his experience, 142% return over that period. And these are the road bumps he's had to suffer along the way. Middle East crisis, the global financial crisis, which morphed into a sovereign crisis. It will be 4 years ago that Mario Draghi came out and said it will take whatever it does to make sure the euro doesn't break up. That's been 4 years in the planning. QE ending in the US, then not raising interest rates at the market, and then raising interest rates at the market. The market can't make its mind up. And outperforming the FTSE 100 handsomely over that period, and outperforming the sector average of all the other funds in a similar position. most importantly, it's about making sure your money achieves its purchasing power by beating inflation. So that's our long-term high risk. We have Mr. D. I do apologise to the ladies, they're all Misters today. He's medium term, and he's medium risk, portfolio 5. Again, he's been through similar road bumps as the same as Mr. H. But there's also beat the FTSE 100 that are taking less than half the risk of the market. The ups and downs have been much less than the FTSE 100. More importantly, adding value by beating the average, and again, making sure we keep pacing with inflation. Mr. K, short-term investor and low-risk investor, only been invested 3 years. Still has the same speed bumps. Significantly outperform the average fund using the same asset class. Now, it'd be unfair to put the FTSE 100 on this because it's taking much more risk, but I'm going to anyway, after I put the inflation one on. We have to start again now. And there's the FTSE 100. So much more volatile over that same period. It's making sure every single one of you in the room is taking the right level of risk. Mr. H, Mr. D, Mr. K, they're all perfectly correct for their level of risk they want and the time frame they're invested in. There's no right or wrong answer, it's whatever's perfect for you guys. Big numbers sometimes get lost. Here's our annualised returns since launch for all the portfolios. We have the growth portfolios in the darker bar, they've been going 11 years. The lighter bars are our income portfolios, they've actually been going 6 years nearly. Comparing those against FTSE 100, and then the Bank of England and inflation. Longer term, significant outperformance. Other big companies do what we do. Henderson's have their own multi-managers. So do Aberdeen, do as Schroders. And what we're going to do, we're going to put them in divisions over 1, 3, 5 and 10 years. So as you can see there, over 1 year, there's 260 funds doing what we do and what these guys do. And if you're in the top, good job I don't have to use maths, 68 funds, you're going to be green, blue for the second division, third and fourth. And what we're showing is, over the long term, we're consistently first quartile. We're happy to give up some short-term performance, because sometimes the market isn't where we want to be invested. Also every year, the Financial Times do something called the Private Client Wealth Management Survey. I know when it comes out because it's always on my son's birthday. 19th of June, he was 11 this year. Dear me, he's like a teenager. He's going to a boarding school, but unfortunately not boarding, he's a flexi pupil. I'm trying to get his mum to change his mind to send him to full boarding. But they go through, there's 43 discretionary fund managers included in this survey. They go through asset allocation, they go through how much money they run, they go through their charges, they also go through their performance. For a balanced portfolio, which is closely linked to our portfolio 5, and a growth portfolio, which is linked to our portfolio 7, and we map it against them. So this is the balanced portfolio over 1 year, 3 years, and 5 years. So we're in the top quartile of that cohort. And the same is for growth portfolios, 1 year, 3 years, and 5 years. So significantly holding our own against some of the top guys in the industry. And more importantly for you, that's the charges. So we're the cheapest among all the discretionary fund managers. Now, some of the guys don't want to publish how much they charge you. I'll leave that to your own discretion to decide why they choose to do that. But we come up very well in that survey. And it is a long and winding road. This is all the portfolios since launch. 1 to 10, FTSE 100 pretty much splits them down the middle. The longer you stay invested, the better the returns. It was important to highlight that there are periods where the market does come under stress. Sometimes they're quite narrow, sometimes they're quite long periods. The longer you stay invested, the better the outcome for you. We do talk long term, but it's important to short term. This is the week before Brexit. So running into the portfolios, the black line is the FTSE 100. Polls, the bookies, pretty much every consensus was we're in for a Remain conclusion. The FTSE 100 went up that period. Then we got the other outcome. It's just to show you that during that period, we were half as risky as the FTSE 100. So it's steady returns, even during times of volatility. Not always. We were trying to make sure the portfolios weren't going to give you a roller coaster ride. We want the nice lazy river ride, not the corkscrew. But with reward comes risks. It's the diversity of what we do that we have to take risks to give you long-term returns. I'm going to start with the east of the world. China's probably the biggest one on our roadmap at the moment. Although we don't discreetly invest in China at this time, it's something that's very close on our radar. This is a huge economy that is going through a transition. It's moving away from the images of big coal-fired factories with smoke billowing into the air, moving to a more service and internet-based economy. Now, luckily for them, they can pull both levers. Being a communist country, they can control supply and demand, which is very handy for this transition from new to old, or from old to new. But it will take time, and there will be a period where China is a screaming buy for the portfolios, but not just yet. But that doesn't mean we're not spending a large chunk of our 728 hours making sure we've done the work before we invest. And Japan. I've heard Rebecca talk about Japan already, that they already have negative bond yields. This is a bit of a dichotomy at the moment, with the central bank refusing to do any more stimulus at this stage. Now, we think Japan is a generational investment. It will take a long time to come through, and there'll be periods where you regret holding Japan, and there'll be periods where you enjoy holding Japan. It's a long-term investment. If you thought that was bad, you want to come to the west now. Greece, continually readjusting their bailout package. It used to be every 3 years, it seems to be every 3 months now that Greece comes to the desk of the European Union and says, please sir, can I have some more? Or please sir, can you just take it away? Markets have become very relaxed about this at the moment. We don't think Greece is going to fall over. Spain had their elections on Sunday, and the biggest fear was the anti-establishment vote. Would that take hold in other countries? Would there be a domino effect from our Brexit? Well, that's changed to amber now. The anti-establishment vote got much less seats than they got. Rojo didn't get a majority, but it was not too far off it, which was good, so we changed that to amber. Italy, their banks seem in turmoil, everything seems in turmoil. There's a lot to be worried about in Italy. France, the only country I know that vote in a president to bring through structural reform, and then he tries to bring in structural reform and everyone goes on strike. Germany, Angela Merkel was the only head to keep her job during the financial crisis. Every other European leader got changed. Their election comes up next year. We don't think Angela Merkel will survive, especially in the face of Brexit. Talking of Brexit, we have us. So Europe looks quite a scary place to invest at the moment. But you need to remember, politics and economies are very different to the underlying companies you can invest in. It does create long-term opportunities, as we've seen from the charts we've recently looked at. Got to talk about Brexit. This is why I was feverishly updating my slides on Friday and Monday. Pretty good turnout, 72% turnout. Anyone guess what the lowest turnout cohort was?
18 to 24.
Yeah. Anyone under 24? Which is raining. So what's the reaction going to be? What's going to happen next? And is there a roadmap to look at? Institute directors did a quick survey on Friday and Monday to British business. 2/3 of people surveyed said it was a negative outcome. 1/3 said they're going to freeze any new hiring and they're going to shelve any capex. 1 in 5 said they're thinking of relocating, whether that's within, outside of London or different parts of Europe, I don't know. 5% they were going to cut jobs. This is your typical knee-jerk reaction before the dust has settled. This is something we don't do. It's up there just to sort of, everyone can roll their eyes and go, oh, really? This is a long drawn-out process. No one knows what's going to happen. I would thoroughly endorse Newsnight on Monday. It's on iPlayer, it's on there for another couple of weeks, I think. It is really good. If you speed through to, I think this is around 25 minutes, they've got some really good graphics of what might happen next. So the outcomes are out, half in, half out, or in, even after the referendum. Now the argument they were saying, Westminster have to vote through any changes to the articles with the EU, Article 50. And they might opt for what's called the Norwegian model. Now Norway isn't part of the EU, it's part of the EEA, the European Economic Area. The easy way to remember who's in the European Economic Area is, it's like the Eurovision Song Contest. How many points do we normally get? 0. Norway, Iceland and Luxembourg. They form part of the EEA as well as the EU. That's the only time I'm going to mention Iceland. We might end up having a snap general election. Now, the Lib Dems have come out and said if they get the majority, they're going to make sure we stay in the EU. And then, of course, we have this petition on the website for another referendum. A bit like when I'm playing my son at FIFA, I'm always saying, come on Toby, best 2 out of 3. If Article 50 is triggered, there are options ahead of us. We have a soft option, which looks very similar to the treaties we had at the moment. We have the hard option, where we pretty much just say, no, we're going to go alone. In that, if you want control over immigration, full control over immigration, you pretty much have to give up everything else. If you want really close ties with Europe and really keen trade agreements, one of the regulations is pretty much you have to have free movement of people. So it's damned if you do and damned if you don't. That's what's going to be discussed over the next couple of years. Action is going to be needed, especially by the Bank of England. Did anyone hear Mark Carney's speech? Pretty good, I felt. Pretty good. It needed a calming hand across what could easily be a very turbulent Friday. They are probably going to cut interest rates. They are probably going to do it in August, and they're probably going to cut it down to 0. Who would have guessed at the beginning of this year we've had 8 years of interest rates at 0.5%? Would anyone guess the next move down would have been to 0? And they're probably going to turn the tap back on for stimulus, for quantitative easing. So some more stimulus into the market. When I said in the previous presentations that we're in an environment that was going to be lower for longer, I think we all underestimated potentially how much longer lower it's going to be. Wow. This is going to take a long time to get up. I could show you charts showing how slow and languid this recovery has been compared to the other recoveries had since the Second World War. This is a long-term process to get out of this. But that doesn't mean you can't make substantial money from your investments. So, August is probably the first flag. That's going to be the Bank of England. It's probably too early for their July meeting, but August, that's the first moment to watch out for. Then we've got October, which is when David said he was going to stand down. There's going to be a new election. Is that going to trigger Article 50? It is in our hands. We decide when to pull the trigger on this. If we do, it's probably a couple of years of untangling everything. So that takes us to October 2018. It doesn't stop there. Being out the EU is being similar to making our trade agreements with Australia, America and the rest of the world. It's a continual process thereon. You're out the club, you have to keep renegotiating. The sooner everyone realises, great, it's changed now. It's a different dynamic we have to look at. It's not good, it's not bad, this is just the way it is. If we voted to remain, this is who we'd be talking about now. And this is probably the biggest risk, rather than how the UK is going to cobble on over the next 6 months. Donald Trump. And it's not just Donald Trump. There's a lot of anti-establishment movements across Europe as well. Now, Spain had their election. They didn't vote in the anti-establishment party, nor did Greece previously. France, interestingly, coming through, and we've got the two Spanish guys over there. One who, interestingly, used to be a clown. Seriously, a proper red nose, long shoes, spinny bow tie clown. This is the environment we have to make long-term decisions in. This is the environment we have to make sure we don't make knee-jerk reactions in. This is the environment we have to make sure that when we do underperform, we stand up here and say, these are the reasons for it, they're valid reasons. At the moment, there was a flight to safety into large cap equities and European debt, government debt. These are very expensive asset classes. It is your classic case of buying high. We don't want to buy high, we want to buy low and sell high. We want to take longer term investment decisions. It's about diversification, diversification, diversification. This is portfolio 6. It's our most popular portfolio. It's got every single asset class that we run. And not only that, it's not just one fund making up the 24% of UK equities. We've got 31 funds making up this entire portfolio. Over the long term, this portfolio has done nearly 110%, compared to the FTSE 100, which has done just over 100%. The FTSE 100 has an annualised volatility of 20%. Portfolio 6 is half of that. You're taking half as much risk. The ups and downs aren't as gut-churning, but you're getting the same return. And even over the short term, this is the chart for the week of the Brexit. We're trying to protect as much as we possibly can on the downside to give you as much upside. You're going to get a questionnaire on this slide. Probably going to tell you line 7, word 3. Which one was it? That's just to verify that you're concentrating and it fulfills our compliance duties. Guys, you've been extremely patient and attentive. Much appreciated. This is the time for any questions. Otherwise, Gerard and Brian and Ian and Felix and Ian have to come up with their pre-made questions to make me look foolish. I'd rather not that happen.
Can I ask, do you think then, if you're in sort of 10 category risk,
yes,
you should actually move to 6 now?
It's a very good question. Only if your risk has changed. Only if you feel you can't tolerate the highest level of risk. What 10's going to have in it is more overseas equities, which will benefit from a weak sterling. We've currently got a weak sterling. One of our Asian income funds that are held in portfolio 10 is up 10% since Thursday. Overseas only is going to be translated back into a weak pound, means good for a sterling investor. Yes, if the market suddenly becomes less casual, as we've seen recently, there'll be bigger drops for a portfolio 10. But over the long term, in this period, you can actually do extremely well. Just making sure you've got the right level of risk for you. So I couldn't necessarily say, no, move across to a lower risk. If your risk profile, if you feel your tolerance has gone down, absolutely.
So what would you analyse as being tolerance against risk? So what things would you take into consideration?
Time frame. We had lots of clients talk to us before the run-up to Brexit, and if they had 10 years to go, this will end up being a blip, as many of the other blips have been on the long-term chart. But if they're retiring at the end of the year, then obviously you have less time to recover any shortfalls. So that's when you have to take less risk. So time horizon is one of the key indicators of how much risk you can take.
7 years.
Yes.
In your personal opinion, what do you see the country looking like financially in 5 years' time?
Wow. I think we'll be in rude health. We've got to remember that within our FTSE 100, 60% of those companies' earnings come from overseas, so that's fine. We've got some of the most innovative and entrepreneurial companies in the mid and small cap, so I think they'll be fine. There'll be some volatility in the short term, but over 5 years, especially if we've got the Bank of England making a more loose monetary environment, stimulating the economy, I think it's probably a good place to be. If you're an exporter, your goods are looking cheaper. If you're importing, that's going to be maybe a bit more of a struggle. But I think over 5 years, I think the UK is looking good. The problem we do have a domestic bias, as we're in the UK. It tends to be one of the larger chunks in the portfolios. But with the funds we're investing in, don't forget all the earnings aren't just UK denominated. I think we'll have a much changed political environment, that's for sure. There was calls for Mark Carney to resign this morning, which I could not understand. You know, the guy's done a phenomenal job up to here. It's not his job to, his job is to say, look, I think the best outcome is X. If the best outcome isn't X, fine, I'll manage that. But no, I think the UK will be in rude health. We'll have a different leader for potentially Labour and the Conservatives and SNP and Liberal. Who knows? Who knows? It'll be really changing. And who knows what the interest rate will be? We could still be in that lower for longer environment. That's for sure. Good question.
Thank you.
Let's say that you put in a lump sum and it's been drip fed into a fund. Let's say, for example, Balkham.
Yeah.
Right. Would there be a point at which you would exploit the drip feed, or would you keep it going? Drip fed.
Wow, good question. You've got in this environment, I mean, if the FTSE had dropped 3 times as much as it did, then it's a case of push the button, pretty good entry point to go in at markets at that point. With the volatility we expect, you'll probably benefit from the gradual drip feed. There's I normally bore you guys with a study from the Sunday Times, Ian Cowie. There was these, well, it used to be 2 brothers and a sister, but it changed to triplets. Good timing Gary, bad timing Bob, and steady Eddie. Bad timing Bob would hoard into cash and invest in the market right at the top, so right at the worst time. Good timing Gary did the opposite, would invest at the perfect time. And steady Eddie just did drip feed all the time. Now intuitively you think good timing Gary's going to do the best, but what he does, once he's invested and he starts building his cash up again, there's steady Eddie that came out top without having any heartache or worry or trying to time the market. So I would always endorse drip feeding, but if there was a cataclysmic event, then that might be a time just to maybe turn the volume up a little bit and put the money in a bit quicker. Good question again. See, I told you guys are the cream. Yes?
You haven't commented on Russia at all in your risk factor, but I would imagine that Europe potentially following suit after Brexit with other countries doing the same thing would create a lot of uncertainty in the political market.
Absolutely. It's almost nervous how quiet Putin has been. I mean, 2 years ago, these charts would all have been about Ukraine and Crimea and how dreadful that is. We quickly forget, and the markets quickly push it back into history. Russia will definitely raise its head again. A disruptive Europe is conducive for Putin. we've got the World Cup there in a couple of years, which seems insanely crazy. Interesting though, a study
Do you
came
think
out.
we'll win this time?
It depends how much drugs they take, I suppose. There was a study came out today, and it was a straw poll of French, Spanish, Italian, wasn't Russian, Irish, and Portuguese. And it was, do you think the EU is a good thing, or do you think the EU is a negative thing? And on the back of Brexit, on the back of the Spanish elections, I think we'd probably all here think the majority of people would have said it was a bad thing. But the majority of people surveyed were saying, actually, we think it's a good thing. It wasn't too much. Ireland was 54%, we think it's a good thing. It was probably only sort of 30% good, 20% negative, and there was quite a big cohort of don't knows. So I think it's dangerous to draw too many conclusions that, you know, we might be the first domino and everyone else falls around. It's interesting that, you know, the Dutch were saying, great, we can have our referendum now, and the Danish were feeling the same. It's that knee-jerk, emotional, immediate reaction, and then sort of the cold light of day filters through and says, oh, what will that mean? Let's just see how the UK get on first before we make anything. So we're the pioneers again, I think, in the European model. But yeah, there's uncertainty prevails. We always think we just have to get to next year, and next year will be a lot more certain than the previous years. But we just have to remember it's a hamster wheel, and these keep coming round and round and round. And there's always arguments for not investing or reducing your risk or other reasons to be fearful. But the longer you stay in, the better the returns. The market's always giving you an opportunity to say, go on, leave, capitulate. And it's having a robust process for the fund managers we use and for us to make sure that we keep the tiller steady. Good question though. It's, again, North Korea's raising its head again with their nuclear tests. China will probably come up again if their data's flat, and the US will be the one we're talking about very soon. So, you know, Bank of England reducing rates, or the Fed raise interest rates again in the face of global outlook. Janet Yellen used the word uncertain 39 times in her last speech, which is unheard of. That's what demonstrates how sad my life is as well. Any other questions, guys?
Sure. What are your expectations in terms of UK property, London specifically?
It's a tricky one. Foreign investment did slow and will continue to slow. But if there's pressure on prices, there'll be plenty, you know, with a weak pound as well, foreign investors will look at that as a massive opportunity, I think. It's an illiquid asset class as well. So we've got a lot of the fund groups have put in some temporary pricing to make sure they protect the long-term investors, which I think is eminently sensible. It's not like in 2007 where funds closed. You couldn't get your money out. This is making sure that the long-term investors aren't punished for speculation, basically. So you could paint two pictures where you can see foreign investment leaving, but with the weak sterling, it makes it look really attractive. And there'll be, you know, if you want to pick a decent bit of real estate in Mayfair or Kensington, you know, there's going to be good opportunities for foreign investors. Long-term asset class for commercial property, still absolutely no. No, good question. It's normally one that trips me up. I have to wait for next time.
Well, as a wind-down question, what are the chances that Scotland might be part of the United Kingdom inside like 3 or 5 years? Mrs. Surgeon having a referendum, and this time clearly with a different mandate. Do you think Scotland might be?
One of the best knee-jerk quotes on Friday was from J.K. Rowling. And she said David Cameron's legacy is going to be the breakup of 2 unions.
Yes.
It all depends on this roadmap. Do we trigger Article 50? Because their argument is rightly that all of Scotland voted to stay in. And you know, oil price will eventually start to creep back up as well. So it will start making their economic model look a little bit better than than if they left earlier? I honestly don't know. I really don't know. It's I did. Here you go. Anyone read Windy this week on Monday?
Yes.
So it's like the Donald Rumsfeld, the known knowns and the known unknowns. That's a known unknown. We know there's the potential, but we don't know what the outcome's going to be. And we coined the phrase "unsurprising surprises." Should we really be surprised? Because we've had so many surprises. It was surprising that Scotland voted to stay with us. It was a surprise that the Conservative got majority, and it was a surprise that we voted to leave. So the surprise shouldn't be unsurprising.
I mean, would it be terrible for the sort of city in Scotland with that been fixed?
Well, it's nearly 2 years ago now they had the referendum. Scary. And talking to the firms there, especially the ones in Edinburgh, big financial institutions in Edinburgh, they've already got their plan Bs and where they're potentially going to move. A lot of them have already changed their head office, regulated addresses as well. It could be a boon for England if they were to leave. A lot of institutions would move down. But then if we're not part of the EU, does it really matter if they stay in Scotland? The more you unravel, the more you can get tied up in knots. It's a great question. And from our point of view, it's one of those that we can spend a lot of time looking at and talking about. And it's really interesting to mull over the different outcomes. But when it comes to running the portfolios, it has very little really to make sure does Rebecca's fund do well, does Dave's fund do well, does Eric's fund do well. It's one of those things that we can take ages to talk about. But the fundamentals of what's going to make individual companies do well or not do well tends to be the duller stuff. But it's an interesting one. There'll be a lot of political points to be won over the next 7 days, 7 months. Yeah. Good question. Thank you, guys. But if there's no more questions, I'm hanging around for a bit longer. I think there's teas and coffees at the back as well. Just thank you for your time and considered questions. I think it'll be a winter seminar as well. Speak to these guys. There's videos now on the website where they try and blur as much as possible to make it more aesthetically pleasing. It's not working, unfortunately. But much to my children's amusement. But thank you very much, guys.